Think about the last time you had to file a claim. Maybe it was a car accident. Maybe it was a hospital bill. Maybe it was paperwork after someone in your family died. You're already stressed. You're trying to do the responsible adult thing. You pull up your policy portal or dig up that PDF you haven't opened in years, and then you see it: cash value, account value, accumulation. Wait, what? You've been paying every month for years. But in that moment, you can't answer the basic questions fast. If something happens today, what exactly gets paid, and to who? How much of what you've paid was protection, and how much was supposed to be growing? And why does the balance look smaller than it feels like it should? Here's what most people don't realize. The moment you need the coverage is often the same moment you discover the money side doesn't work like a normal investment account. And that's not an accident. That confusing cash value language? That's your clue you're holding a bundled product, insurance plus an investment, inside the same contract. That includes whole life, universal life, indexed universal life, variable universal life, and a bunch of annuity-like setups. Let me be clear about something. These products can do what they're designed to do. The problem is what you were led to expect. You were sold the best of both worlds. Protection and growth. Here's the twist. The growth doesn't start where you think it starts. In many cash value life insurance policies, a big chunk of your early premiums gets eaten by the machine before your account value ever has a chance to compound. Commissions to the salesperson, policy expenses, and the cost of insurance. The internal charge for the death benefit, the NAIC, state insurance regulators, spells this out in their Life Insurance Buyer's Guide. First-year commissions on whole life are commonly around 70% to 90% of your premium, with universal life often still around 50% to 70%. So that investment account you think you're funding? In the early years, you're often funding the sales and policy costs first. Then you get the second drag: conservative guarantees and crediting rules that limit upside. You're paying for two objectives inside one product. That trade-off tends to create quiet underperformance, and it's extremely hard to compare on a brochure. And it goes deeper than that. Once you see the bundle, the next question is brutal. Where did your premium actually go? Think of your payment like a paycheck that gets hit with deductions before you see your take-home pay. Your premium goes in, then the policy skims off layers: commissions, admin costs, and the cost of insurance, COI, the internal charge for keeping the death benefit active. Only what's left can build cash value or account value. And that's before you even talk about surrender charges, penalties for leaving early, so the policy stays sticky. This is why year 1 to year 5 can feel like money vanished. The commission layer alone explains a lot. The NAIC's Life Insurance Buyer's Guide notes first-year commissions are often around 70% to 90% of the premium for whole life, and around 50% to 70% for universal life. Translation: your early payments are heavily front-loaded to pay the salesperson and the policy's setup costs. So if you're paying, say, $500 a month for 36 months, that's $18,000 out of your bank account. You look at your statement and see an account value that's way lower, and you assume the market did something. But it might not be the market. It might be math. For you, the implication is simple and empowering. Stop judging the policy like it's a brokerage account. It's not. It's a contract with internal deductions. If you're staring at a balance that's below what you've paid in, that doesn't automatically mean you got scammed. It means you need to identify each deduction and the surrender schedule, because those determine how long you're locked in. Now here's the part they really lean on to keep you calm: the word guaranteed. But what does guaranteed actually cost you in growth? After the fee stack, the next quiet drag is how returns are credited, especially in indexed products. Here's what most people don't realize. Linked to the S&P 500 doesn't mean you get the S&P 500. In indexed universal life, your credited interest is usually controlled by a formula. 3 common levers show up: a participation rate, the percent of the index gain you get, a cap, the maximum you can earn, and sometimes a spread, a chunk subtracted from gains. It's like ordering a slice of pizza and being told, you get 90% of the slice, and also it can't be bigger than this, and also we're taking a bite first. A concrete example shows how fast that adds up. One explainer breaks it down like this: If the index gains 12% and your participation rate is 90%, you're at 10.8%. But if your cap is 9%, you get 9%, not 10.8%. Another carrier example shows a 20% index gain, 100% participation, and a 4% spread turning into a 16% credit. And there's an extra twist. Many indexed policies use the S&P 500 price index, which excludes dividends. An actuarial review notes that from 1955 to 2019, the S&P 500 annualized about 10.4% with dividends, but about 7.2% excluding dividends. That's your baseline before caps and spreads. So what does this mean for you? The floor that prevents a negative credit can feel comforting. But it doesn't automatically beat a low-cost diversified portfolio over decades, because upside is constantly being shaved down while policy charges keep running. This is also why illustrations can look rosy. They show a path where caps stay generous and crediting stays favorable. Real life? Caps and participation rates can change. Now for the comparison most brochures avoid, because it forces the math into the open. You now see the two traps. Your money gets deducted first, then your upside gets limited. Next, you're going to run the clean comparison that exposes what this really costs you, because once you see the deductions and the caps, there's only one fair question left. What if you just unbundle it? One product for protection. One product for growth. Term life for the "if I die" problem, because it's designed to be cheap coverage for a specific window. Then you invest separately in something you can actually see, measure, and change, like a low-cost retirement account or brokerage. And when you run that side by side, the brochure gets very quiet. A real-world illustration from an Ohio national whole life policy issued in 1996 shows the cash value internal rate of return around 3.95% at the 20-year mark. In the same document, the S&P 500 real, inflation-adjusted, return over that 20-year period is shown as about 8.19%. That gap isn't a little. It's the difference between compounding and treading water. Now picture the archetype. The 35 to 45-year-old parent paying a high bundled premium because it sounded disciplined. If the protection you actually need can be covered with a much cheaper term policy, the difference you free up is what builds flexibility, emergency fund, retirement, college, whatever your real priority is. And yes, bundling can still be valid. But it's narrow. Estate planning, a lifelong dependent, high earners who already maxed retirement accounts and need a specific, permanent insurance structure. If that's not you, then the default assumption should be, protection and investing deserve separate math. So what do you actually do with all of this? Without making an expensive emotional decision, here's exactly what to do. Not vibes, numbers. Step 1. Identify what you own. Whole life? Universal life? Indexed universal life? Variable? An annuity-like contract? Find the most recent annual statement and the in-force illustration. Step 2. Pull 5 numbers today: your premium, current cash value, account value, surrender value, the current cost of insurance and expense charges, and the projected values at 10 and 20 years. Step 3. Ask these 6 questions in writing. What's the surrender schedule? What are all ongoing charges? How is index, interest credit calculated, cap, participation rate, spread? What happens if you reduce premium? What year do you break even versus total contributions? Which death benefit option are you on, and how does it affect cash value growth? Step 4. Run the clean comparison. Quote term insurance for the same death benefit and term length you actually need. Then estimate investing the premium difference in a low-cost diversified account over the same time horizon. Step 5. Decide with a rule set. Keep it only if the protection need is permanent and the numbers still make sense. Otherwise, explore reduced to paid up, a 1035 exchange if appropriate, or replacement, but never cancel before new coverage is approved and in force. If you want another system mechanics breakdown, watch the next video on how to read an in-force illustration without getting manipulated. And if you subscribe, you'll keep getting this kind of clear translation of the fine print.